Welcome to the final webinar in our Finance for Expats webinar series. Today, the webinar aims to help you ensure that you get up to speed on your US tax filing requirements, the US expats, covering the filing requirements, deadlines, forms, tax credits, to those that are specific to Americans abroad. And what to do if you get caught up on if you need to get caught up on multiple years of back taxes. So if you have any questions during the webinar, you'll see that you can ask a question on the link on your screen. We'll answer during the session if we can, and any that are not covered during the session, we'll answer by email after the webinar. I'd like to welcome Eric Scali, and Eric, over to you. Perhaps you could start by telling us a little bit about yourself and H&R Block.
Sure thing. Thank you, Nigel. Appreciate it. Make sure everyone can hear me okay. Just sound check real quick. Good to go?
Yeah, that's fine.
Cool. So again, my name's Eric Scali. I'm an attorney for working at H&R Block, focused in international taxation, mostly for individuals. I've been working for H&R Block for roughly, I think it's my 11th year now. I started out in a tax research and compliance division where I focused on international taxation, mostly again for individuals, and then transferred over to the expat service that we started in 2014 and have been with them in different capacities ever since. So we saw a need kind of for a service for expats living abroad that aren't able to make it into, you know, a tax office in the US or even living where they are abroad. So that's how the H&R Block Expat Tax Service started, and we've been going at it ever since. So that's a bit of a background on myself and the business. Today, I thought we would get into some general topics for taxes for expats. And what I'll be covering today, we're kind of three different sections. So I'll be getting basics of taxes for expats, covering just kind of your most basic kind of concepts. Then getting into a little bit more advanced topics that are specific for expats. And then jumping into getting back into compliance if you have not been filing or maybe have missed filing certain forms or something like that. So we'll kind of touch base on each three of these points, but we'll jump into the basics for taxes, basics of taxes for expats first. So the first thing I'll jump into is filing requirements. So in general, you know, as a US citizen, whether you live in the US or you live abroad, there is a filing requirement if you meet a filing threshold. In the current year, the filing threshold for a single individual is $12,550, and that looks at your gross income. So it takes wages, stock sales, dividends, interest, all that into consideration. If you are married filing separately, which is common for a lot of expats living abroad who are filing for themselves, maybe married to a spouse, but that spouse is not a US citizen. So in that case, there's actually a very low, there is essentially not a threshold for filing. So most of those people need to file. And the reason for that is that the kind of filing requirement threshold is geared towards the standard deduction, and a married filing separate taxpayer is not automatically given that standard deduction because they potentially, if the spouse files and itemizes, then they're not afforded a standard deduction. That doesn't apply in a lot of cases. So it's, you know, you'll still be afforded that $12,550 deduction, but that doesn't take away the need to actually file the return if you essentially have any income. And one common misconception about filing requirements too is, let's say you earn wages and that's the only income you earn, and you earn, let's say, the equivalent of 50,000 USD. in most situations, you could exclude that using that foreign earned income exclusion. So some people have the conception that because of that, they don't need to file. But it's actually that form, that particular exclusion is, and we'll get into it a little bit more, is actually an election that you make. And so you do need to file a return claiming that form, or else you potentially may lose out on that ability to exclude that income in the future. So just know that even though you're under that threshold, there is still a requirement to file. So next, to quickly go over deadlines. Deadlines are a little different for most expats. So the typical deadline is if you're living in the US, it's April 15th. If it falls on a weekend like it does this year, it moves forward and actually ends up on April 18th this year. If you are living abroad, so most expats that is a June 15th deadline. And then the extension for both people living in the US and living abroad, if you file an extension before your regular deadline, you can extend till October 15th. Now, the important factor of that is you have to consider both penalties and interest when you're looking at extensions. So you don't accrue any penalties until after your original deadline. After the original deadline, you will accrue what's called a failure to pay penalty if you do actually end up owing any amounts due on when you eventually file. And that will go through, that essentially keeps accruing until you file and pay that off. And likewise, interest also accrues, and it actually accrues from post the April 15th date, whether you're expat or not. Now, both of those are relatively small amounts compared to like larger penalties, like failure to file penalties and things like that. So you do avoid the larger like failure to file penalties by either filing timely or filing an extension and filing by that time. So just wanted to cover that real quick. There is some confusion over penalties and interest when it comes to extensions. And then there's the FBAR deadline. Technically, it's April 15th is the deadline, but they give you an automatic extension without having to do anything. That gets you out to October 15th. So essentially, you can look at the deadline as October 15th for any given year. And if you don't know what an FBAR is, we're going to get into that a little bit. So don't worry about if you don't know yet. Okay. So next, I'll get into some expat benefits. So we're going to look at items that you can utilize as an expat to either eliminate or minimize double taxation from being taxed in a foreign country and being taxed in the US. So the first one we'll look at is the foreign earned income exclusion. I would say this is probably the most common one. It's probably the most known about, or known anyways. And what it allows you to exclude up to a certain threshold of earned income. And what earned income is usually income from wages or income from freelance self-employment work. It doesn't cover items like capital gain, dividends, interest. That is not applied to this foreign earned income exclusion. It only looks to those categories that are considered earned. And it affords you the ability to exclude up to, I think in 2021, it's $108,700. So it is it's adjusted for inflation, so it goes up kind of every year, but that's the threshold for 2021. Now, in order to claim this exclusion, again, you have to meet one of two tests. There's what's called a bona fide residence test and what's called a physical presence test. The bona fide residence test is usually that one is applied for people that are living overseas for many years, usually let's call it more than 2 or 3+ years. Don't have really any like severe visa restrictions, meaning they usually have a work visa and it can be renewed, or they have a permanent resident visa. If you're on a limited visa where it's like a 1-year visa, the bona fide residence test may not apply to you. So it kind of requires you to have some kind of formal presence in that country abroad. The physical presence test, on the other hand, only looks to a 365-day period. So instead of a calendar year, January to December, it looks to any 365-day period. And I'll discuss what that means a little bit more. But essentially what you have to do is you have to have what's called a tax home in a foreign country for 330 days out of 365 days, consecutive days. And a tax home for US tax purposes essentially just means a place where you regularly live and work from. So usually that requires you kind of to be in a place for a year or more. But sometimes if you're moving around a lot, that requirement is really not in existence. So it kind of looks where your regular place of living and work is conducted from. So for instance, let's say you typically work in New York, but are transferred to London for 8 months and then go back to New York. You wouldn't qualify for the foreign earned income exclusion because you couldn't meet either one of the bona fide or physical presence tests. But if you transfer from the New York office to the London affiliate, start working for the London affiliate under a work visa in London, you're likely going to qualify for both, unless you're traveling back to the US a lot, where you may fail the physical presence test, but you'll still probably likely beat the bona fide residence test because you've kind of shown formal moving to London formally anyways. So back to the physical presence test. If you do meet either one of those, the 330 days within that 365-day period, and again, it doesn't have to be a calendar year, it could be July to June or whatever 12-month period it is, then you are eligible for claiming the exclusion. And if you are, if it is like a partial year, so let's say you meet it for part of 2021, let's again use, let's say July 2021, and you intend to live in that foreign country up till June of 2022, then you can claim a part year exclusion for that part of 2021 that you were in the foreign country. So let's say you work for a US company beginning of the year, that's going to be US source income because you're living and working in the US. You can't exclude that, but then you transfer to the London affiliate, start working for that overseas. That's going to be foreign income, so that can be excludable income. And as long as you meet that test for the 330 days, 365 days, they'll prorate the maximum amount that you can. So essentially, let's cut it in half. So it's 108,000 roughly. It would be, you know, the max you could claim in 2021 for that part year would be for 54,000. So that's how the proration works for that part of the year that you qualify for in that situation. Now, in addition to the income exclusion, you can also claim a housing exclusion, but that housing exclusion only applies to if you're renting a place overseas. So if you own, you can't use your mortgage premiums at least or interest payments to apply against that exclusion. So it only looks to a kind of rental housing when you're living abroad. And that includes what you pay for rent. It also includes utilities and some certain other items. And how that works is if you make or if you pay over the equivalent of, let's call it roughly 17,400 in USD in rent and utilities and so on and so forth, then that amount above the 7,400 you can use to increase the exclusion that you have for the year. So let's say you qualify for the full year, you have that 108,000, and you have 30,000 of housing, rental housing kind of expenses. So if you subtract that 17,400, you have an additional 12,600 to add on top of that 108. So now you can exclude essentially up to like 120,000 or a little slightly above that. So the earned income exclusion and housing exclusion kind of go together. The same test apply for both. But again, you have to kind of have above that baseline amount for expenses to utilize the housing exclusion. Alternatively, we have the foreign tax credit. And how that works is it's a dollar for dollar credit applied to the US return for taxes paid in a foreign country on that same income. The one key here is it categorizes income, meaning that it looks at wages and then passive income separately. So you can only claim, for instance, let's say you have 100,000 in wages and 1,000 in interest. And let's say that 1,000 in interest isn't taxed in the foreign country. You can't then allocate what you pay in taxes in that foreign country to both the wages and interest on your US return. It only applies against the wages because that was what is subject to tax in that foreign country. So that's kind of how the categorization of the different items of income for foreign tax credit works. But it is, again, a dollar for dollar credit against that tax you paid in the foreign country on that certain item of income. You can use the foreign tax credit and the exclusion together, but you can't benefit for both. So meaning if you use the exclusion and you would first apply that, and then anything left over the foreign tax credit would apply to. So let's say if you earned 150,000 of wages, then you could exclude up to 108,000, and that remaining portion you could apply the foreign tax credit against. Some people do that. Usually, when you're going into the exclusion is claimed before the credit in a lot of cases, like when people are self-filing or just in general. But then they start earning over that kind of exclusion threshold. So they'll continue to claim the exclusion, but then also apply that foreign tax credit on top of it. You do have to prorate, so obviously you can't like benefit from both, like I said. So there is kind of an equation you use to make sure you're not applying the foreign tax credit on the amount of what you excluded. You can only apply it on the unexcluded amount. Now, the question is sometimes comes up, which one is better to use? It really depends on the situation. So I'll give you some scenarios here. With the exclusion, if you claim the exclusion, there are some credits that you can't claim. So there's what's called a child tax credit. If you use the child tax credit, it first applies against any tax you have, and then a portion of it can be refundable so long as you're in certain income thresholds. And now, if you use the foreign tax credit, you would still be eligible for that refundable portion of the credit. But if you use the exclusion, even if you use the exclusion in conjunction with the foreign tax credit, you are not eligible for that refundable portion of that tax credit. You can still get the non-refundable, meaning it can apply against the tax you owe, but if your tax then goes down to zero, any portion left over essentially is waived. You can't claim that as a refund. So that is typically applies when you are filing a return and you have a dependent child who's under, I think, under 17, in some cases under 18 on your tax return. So that is one key thing to consider when you're filing and you have dependents, that the foreign tax credit may be the better way to go because you'd be eligible for actually a refund, even though you didn't really have paid any withholdings or any taxes in the US. Another consideration is sometimes the exclusion works better if you have untaxed investment income. And this is a common scenario. Let's say you still maintain an investment account in the US, you're earning dividends, interest, capital gains there. Typically, they don't withhold taxes on investment income in the US unless you request it. And so even though it's subject to tax, there's no US tax withholdings. You can't use the foreign tax credit against it in most cases because it's US sourced income. And so you would have a tax liability in US against that income. Now, if you use the exclusion, you could exclude your foreign income, your foreign wages, let's say, and then you still have your standard deduction, that $12,500 amount that you could apply against your US investment income to reduce the tax there. When you use the foreign tax credit, it doesn't work out the same way technically, and so you'll end up usually with a higher tax bill when you have like US investment income with no tax withholdings than when you use the exclusion, because you get that extra benefit of that standard deduction. So that's another scenario. The last one is generally in higher tax jurisdictions, which is compared to the US, a lot of them, especially in Europe, other than Switzerland, I would say is probably the outlier there in Europe. The foreign tax credit may be better because what you don't utilize, so let's say you pay a 40% tax in the UK, and your tax liability in the US is 25%, you have a 15% unused benefit. You can apply that forward for 10 years for items of income that you may receive that could be taxable in the US, but not in the foreign country. One item that comes to mind is like a severance payment. So you can get like a non-taxable severance payment in the UK, but that would be taxable in the US. So the tax from that severance payment can be essentially eaten up by the foreign tax credit carryovers that you receive. Another situation could be pension distributions. Those foreign tax credits can apply against those as well. The carryovers anyway. So those are some scenarios of thinking which one is better for me to use. The next kind of benefit, I'll talk about this briefly because there's some misconceptions of tax treaties, but there's tax treaties in place with a lot of countries. You know, the US has, I think, a tax treaty with pretty much every country in Europe, or most of them anyways. How they apply, they really look to eliminate, again, double taxation between the two countries, but there is limited benefits for US citizens. And the reason for that is there is a clause called the savings clause that are in most every tax treaty. And what that savings clause essentially allows is it allows the US to tax US citizens as if the treaty were in place, other than for certain articles within that treaty, and it's limited articles. So the main benefits typically, that US citizens get when applying treaties are Social Security tax is usually limited to one of two countries. So when you're you know, retired and you're receiving Social Security, whether it's a US Social Security or the equivalent like a state pension or whatever in a foreign country, usually that's only taxed in one of the two countries. The other item is what's called resourcing of income. That allows for, let's say you usually work in Belgium, but you take a lot of business trips back to the US. Because income is sourced to where you're working at the time, technically the income you earn in the US is considered US sourced income, And so you couldn't apply the exclusion or the foreign tax credit against it because you can only apply those against foreign income. But what the treaty can do is if it's for a limited time, it will essentially resource that as if it was foreign source income and allow you to claim a foreign tax credit against that resourced income to offset tax in the US. That's a pretty big benefit in today's society where there's a lot of, you know, moving around, or used to be anyways, a lot of visit trips and things like that. So that's one scenario. You can also resource other items like pensions to help eliminate that double taxation too. So there's that benefit that applies to US citizens. And the last one is certain countries, and there's only a small amount, 5, allow for kind of a mirror treatment of pension benefits. And usually what that means is pension contributions. And I'm going to get into that a little bit, so I'm not going to cover it in depth right now, but it'll come up here shortly. Okay, moving on to state tax filing requirements. So even though you have moved abroad, there's the potential that you could still be subject to state tax for the state that you lived in prior to departing. So state tax usually is levied on a concept called domicile, and domicile is a different concept in the US than it is in some European countries. So in the US, what domicile means is essentially it's your fixed home where you will come back to if you leave, essentially. And you can't have a new domicile until you've set up a permanent new home somewhere else. So there's some argument in case law and you know, for certain states and just in general, that if you move to a foreign country and you don't have the ability to live there permanently necessarily, you really haven't established a new domicile because you can't live there permanently. So it'd be like if you have visa restrictions or something that would allow you to only stay there for 2 or 3 years. Now, I think anymore that's pretty few and far between, and a lot of states have exceptions for even if you are considered a domicile resident for like non-resident domiciled residents. If that's kind of a weird term, but I know California and New York are kind of 2 states that have that kind of concept. So even if you are technically a domiciled resident of one of those 2 states and you're living abroad or living outside of the state, doesn't really care what other state or jurisdiction you're living in, and you meet these certain requirements, they will tax you as a non-resident, meaning that only income earned within that state would be taxable. So that's one kind of exception that applies. I mean, again, not every state has that, but there are some states, especially East Coast states and California and certain states like that have those situations. Additionally, some states follow the exclusion or will allow a foreign tax credit, although that one's very limited in states. I'd say more states kind of follow the US treatment for the exclusion. And so like, even if you are considered a resident, let's say of Virginia, that would be one that comes to mind that doesn't really have an exception, but affords the ability to claim the exclusion. And a lot of times Virginia is pretty active about going after residents that have moved but haven't kind of officially abandoned their domicile, in at least in the sense of what Virginia thinks, right? So they may levy, if you don't file there, they may levy a tax saying, no, well, you know, you're still liable for tax, or you need to file a tax return proving that you're not. So let's say in that situation, you excluded all your income and you don't have a tax liability, you could essentially file a return even as a resident in Virginia and get that same benefit, where you wouldn't owe anything there because they allow for the exclusion too. So there are certain situations for certain states. Again, the concept is domicile. So if you have been living abroad for many years, obviously state filing requirement is not going to be an issue. Usually, even if you move abroad with the intention of staying abroad, the last time you'll have to file a state one is that that year that you move from whatever state you're living in to the foreign country. And then after that, you wouldn't really technically have to do a return unless you had a rental or some other type of income that's sourced to that state. And rental would be the most common scenario, I think, a rental property. So that's a little overview of state filing requirements. As an expat, again, each state is different, so it's you know, really you got to look to the situation, and that's where kind of tax advisors come in with a little bit of knowledge of how to go about treating that can help. And lastly, kind of for the basics, so FBAR filing. So what is an FBAR? So the FBAR is very important to file, because there are large penalties associated with not filing it, and it's a pretty low standard for filing the form. So you're required to file this FBAR if your combined balance in non-US financial accounts is more than 10,000 USD in any given year. So it's a combined balance. It doesn't look per account. It looks at all your accounts combined. And again, it's any non-US financial accounts. So it's not only bank accounts, investment accounts, it's retirement accounts you have with your employer or individual retirement accounts. It could be insurance contracts that have a cash value portion to it, things like that. So it kind of looks at a lot of things you may not consider, and the threshold is pretty low. So so this filing is pretty typical for a lot of clients living abroad. Now, it isn't technically an IRS form, but is regulated by the IRS, meaning that that it's filed like with a different department in the Department of Treasury, but the IRS does all of like the regulating and issuing of penalties and so on and so forth. The penalties associated with not filing this form can be 10,000 plus. It depends on whether it's non-willful or willful, and it's levied when they are filed late and there's no reasonable cause or good reason that it's filed late. And we'll get into more, like if you haven't filed these in the past, what is a good option for you to kind of get caught up without having to worry about these penalties. We'll talk about that at the end of kind of the presentation. There's one other thing to consider with this. So not only does it look to accounts that you own, but it also looks at accounts you have signature authority in, which could be your children's accounts, it could be business accounts, things like that too. So it factors into a lot of different things. Mostly it's got to be pretty standard at your bank and investment accounts, but it can be considered other things as well. Okay. Now moving on, I'm going to talk about a few what I call advanced topics that expats really should consider. So we'll dive into the first one, Form 8938. So much like FBAR, what we just talked about, this form was kind of instituted when FATCA, the Foreign Account Tax Compliance Act, was passed back in early 2010s. And what this is essentially a mirror form of the FBAR, but it's an IRS form instead of another, like a different Department of Treasury form. But this form has much higher filing threshold. So instead of the $10,000 threshold, if you're living abroad and you're filing a single, let's say it's 200,000 at the end of the year, or 300,000 at any point in time in the year. So your accounts have to exceed a 200,000 threshold or 300,000 any time during the year, which is a much higher standard than the 10,000. So This form isn't as required as much as the FBAR form, but it is something you need to consider because it again has very high penalties that can be levied if you don't file it as well. It pretty much reports the same type of accounts as FBARs. There might be a few additional ones that you report in 8938 that you wouldn't on the FBAR, but for the most part, it's the same. All right, foreign retirement plans. So this is a very, I think, under talked about topic, if you will, in regards to expats. So how the treatment of non-US retirement plans when you're filing a US return. So in general, there's usually three or four tiers, most commonly 3 tiers of retirement plans in both the US and in Europe too, and most other countries. So you have your kind of social plan with your Social Security or state pension. You have your employer-based plans that are like your 401ks or your general employer plan in the UK or wherever in the foreign country. And then you have your individual plans, which will be your IRA type accounts in the US or the equivalent abroad. So let's talk about there's not much to worry about with Social Security type plans. There's nothing really until you receive a distribution that you have to worry about for those. They're not reportable unlike FBAR or 8938s or on your tax return in general until you receive a distribution, and then they're taxable on your return. Other than that, you really don't have to do anything with them. Employer plans, on the other hand, those are typically required to be reported on like an FBAR 8938, the value of those. In addition, from a tax standpoint, in most countries, there's only 5 exceptions. Any employer contribution to your plan would actually be considered additional compensation that would be taxable in the US. So let's say, again, you earn $100,000. Your employer contributes 5% to an employer plan. So that's 5,000 from their side. And you contribute 5,000, which is another, or 5%, which is another 5,000. So technically there was a $10,000 contribution to your retirement plan during the year. In the foreign country, what may be showing up as taxable income in that country might actually be 95,000, because what it would do would be your 100,000, and you get to deduct the amount that you contributed to the plan, which is 5,000, and then you could exclude the employer portion because it's a non-taxable benefit to you. So it would be 95,000 is taxable in, let's say Switzerland, but in the US, it'd actually be 105,000 that would be taxable, because you don't get to deduct your employee contribution, and you have to include your employer contribution as additional compensation. So this is a concept that's not probably well known, I think, unless you've been filing with tax advisors that are knowledgeable about this concept in the past. So that is something that you want to consider. There are 5 countries that afford relief through the tax treaty. UK, Netherlands, Belgium, what's the other one? Germany are the 4 in Europe, and then Canada would be the 5th. So there are limited countries that do essentially mirror the treatment in both countries, but for the most part, that isn't the situation. And then individual plans can be very convoluted. There could be potential foreign trust reporting requirements for individual plans, even though the IRS has recently kind of provided a relief for a lot of those plans. There are still some plans that get subject to that, depending on the situation. It's a really kind of in-depth analysis, so I'm not going to get into it, but reporting requirements for employer plans are typically FBAR 8938. With individual plans, it would be the FBAR 8938 and potentially a foreign trust form, which is a Form 3520. So also something to consider if you have those individual retirement plans, you may want to get some guidance on whether you should be reporting those additional informational returns that the IRS requires. Investments. Okay, so another topic that comes up a lot. So when you are living abroad and you're investing in non-US securities, you just need to be aware that if you invest in any type of pooled fund, which would be like a mutual fund, an ETF, or a unit trust, things like that, those are considered what are called PFICs from a US tax standpoint, and they do not afford very favorable tax treatment. So when you are investing, just be aware that, you know, if you're going to invest in those funds, that you need to consider the US tax treatment of it, because it may offset the benefit of having ownership in those funds from a financial standpoint. Now, there are ways to minimize the tax treatment, meaning that you can get closer for it to be treated like a capital gain type investment, but not essentially the same. So you can make what's called a mark-to-market election, which will tax it on a year-to-year basis, even if you don't sell it. So it's not ideal, but it does give you better treatment than the default treatment of typical PFICs, which is not great. So again, that applies to pooled investment funds. It doesn't apply to like stocks or anything in that usually is sold by itself, bonds, stocks, things like that. It would be anything that's kind of wrapped in a pool or wrapper. So just consider that. Another thing you need to consider, and this is more for people in the UK, so ISA plans, while not taxable in the UK, are still subject to tax in the US. So they are not tax-free plans in the US. So just consider that too when you own ISA, that you know, it's beneficial still, but those investments are still subject to tax in the US. And lastly, probably a common one that comes up that's missed a lot, owning a business abroad. So owning a small business even is the most common situation. So if you own a business, there can be reporting and tax consequences for owning that business abroad that you may not be aware of. So the common forms that trigger this type of filing are like private limited companies, SALs, SARLs, GmbHs, anything with limited liability, essentially, that's not a US entity set up, can be subject to these small business or foreign business filing requirements. Now, if the ownership is more than 50% owned by US individuals or even US partnerships or whatever it could be, US tax filers, let's say, then it can be subject to these new tax filing rules under what's called a GILTI regime, which essentially taxes your earnings on a year-to-year basis rather than when they're distributed, in the US at least. Now, there are some exceptions to that. You can make some elections to help minimize the tax there. But again, this would be a whole other section topic to talk about. So I'm not going to get real in depth with it. But if ownership of the business is more than 50% owned by US persons, then you can be subject to that GILTI tax regime. There's also filing requirements to file when you own a foreign business, Form 5471. And there's 4 different situations typically where you have to file that form. The most common ones, I'll give you actually 3 common scenarios. So common scenario number 1, you own it solely 100%. So you're subject to both the reporting requirement and the tax regime, the GILTI tax regime. Second common scenario, you own it 50-50 with a spouse, but your spouse is a non-resident. It's technically not owned more than 50% for at least the GILTI regime, but you would still be subject to filing the 5471 informational return to report that business, it's quite in depth, the form, and also has large penalties if you don't file it. So just keep that into consideration. And then the other one is, you see this sometimes where it's a 99 and 1% split between spouses. The same concept I just talked about, even if you own it 50-50, that concept of owning it 99-1, it's the same concept applies. So you still have the filing requirement, but if you're the 1% owner and your spouse is the 99% owner, you wouldn't technically be subject to the GILTI regime so long as your spouse is not a U.S. citizen or a non-resident of U.S. anyways, but still has the filing requirement there. So that's the three common scenarios kind of, we typically see in our business with setups of small businesses. So just something to think about if you do own a small business. I think these next kind of slides we'll get into, we're getting back into compliance. This is a discussion if you have those but haven't been filing certain forms, 5471, FBAR, 8938. How do you get back into compliance? So first of all, just kind of talk about avoiding penalties and passport restrictions. Let's cover that before we kind of get back to the streamline compliance procedure, which is the #1 benefit right now of getting back into compliance. So, all of those forms I've talked about that are informational returns, which are the 5471, the FBAR, the Form 8938, things that report small business, foreign accounts, foreign trusts, anything like that, are going to have large penalties associated with them. So not filing those timely can be very costly from a penalty. And when I say large penalties, they usually start at $10,000, like a statutory $10,000 penalty, and they go up from there depending on the situation. So again, nothing you really want to deal with, especially on a multi-year basis, because then you're looking at, 10,000 times 3, $30,000 if you didn't file for a form for those years. So want to stay on top of it for sure. In addition, the IRS in the last few years put a passport restrictions in place if your tax debt is more than 55. I think it's adjusted for inflation. I think it's 55,000 for this year. So that's pretty large, but if you factor, let's say you haven't been filing your returns, and for some reason the IRS, they can do what's called a substitute for return, so they could file for you, right? And they wouldn't claim all the benefits that you could claim if you filed yourself, because those are elective benefits. So you may end up owing, let's say, 15,000 on each year, and maybe they file for 6 years, because typically if you don't file, they'll go back for 6 years. And so that adds up. That gets you past the 55,000. So now you actually have like a $55,000 debt that you could be limited on using your passport. So that is something to consider as well. You want to stay on top of filing and make sure like you're either in compliance. If you do owe a large tax bill, that at least you're in compliance, like you have an installment agreement or something set up where they won't institute that passport restriction. But you want to try not to get there in the first place by utilizing the benefits you have, that you can reduce the tax liability that you would otherwise incur. Okay, so if you haven't been filing for many years, or even if you have been filing, but you just realized, or you come to realize that you need to file some of these other forms that you didn't originally file. Let's say a 5471. Let's say I do own a foreign business. I've been filing it as self-employed ever since I had it. So how do you get back into compliance? Well, luckily there's still a procedure for that. It's been around for, I think since 2012 or 2013. That essentially allows someone who hasn't been filing certain forms or returns, or hasn't been filing at all because they weren't aware they needed to file or they weren't aware they needed to file even like FBARs. Let's say you have been filing returns, but you haven't been filing FBARs. So that can kind of play into that too. So the two qualifications of meeting that, let me jump ahead here. So how do I qualify for the streamlined procedure? It's really kind of two qualifications for the offshore procedure, meaning the one that's more beneficial that you'll want to try to typically use. So that one is that you've lived in a foreign country without a U.S. abode, meaning a U.S. kind of permanent home, for at least 330 days within during one of the last 3 years. So as long as you've been living abroad and you haven't spent more than 35 days in the US in each of the 3 years, you're good to go, at least for the first qualification to streamline. The second is that the conduct that led to not filing either returns or not filing certain portions of the return was non-willful. And the standard for non-willful is kind of very specific in this streamline case, and I'll read it kind of verbatim. So it says non-willful conduct is conduct that is due to negligence, inadvertence, or mistake, or conduct that is a result of good faith misunderstanding of the requirements of the tax law. So pretty wide open there. Again, we've submitted a lot of these, and I don't think we've really had a problem with any of them that we submitted that we've deemed that could be submitted through the streamlined procedure. And again, I think that can apply to, let's say you were aware about filing a return, but you had no clue you needed to file this 5471. The process would still be for you. So it would be, instead of filing an original return, you'd be filing amended returns to claim that, oh, I originally filed, but I had no clue I needed to file this form 5471 for my UK private limited. And so that's kind of what you would do in that situation. So what needs to be filed when you do that? You have to file the last 3 years of tax returns, last 6 years of FBARs, and then a certification form that you essentially certify the reason for not filing those certain forms. And the benefits of that are that they essentially waive any kind of non-filing penalties. So the large, very steep penalties, they would not assess. Nor do they really even assess like failure to pay or failure to file penalties. They do assess the tax and interest still. So you still need to pay the tax and interest, but the large penalties, even the smaller penalties, are kind of waived, assuming they kind of approve everything, which again, is most cases they do. There's no formal like acceptance letter they send or anything like that. It just usually gets processed, and it's been processed because there isn't any penalties assessed. So that's kind of the streamlined overview. Again, there's a lot more to it, but that's kind of the overview of that procedure. The last thing I want to talk about before I take any questions is stimulus payments. So there was 3 rounds of stimulus payments in the US, and you got those stimulus payments so long as you made under a certain amount of money or threshold. Those do apply to expats. So if you would have been eligible for receiving them but haven't received them, you still can receive them. So 2 of them are actually credits on the 2020 return. So let's say you haven't filed yet for that year, you could claim those credits on that return. One of them is a credit for this year's return, the 2021. So you could still claim that if you haven't received it as well. Again, they have, filing threshold, or I would call it income thresholds to what you can qualify for. But one thing they didn't really consider was using the exclusion. So technically, you could earn over the amount of what would qualify for receiving the stimulus. But if you applied the exclusion, it gets you under the amount and you would actually be eligible for the stimulus. So it can be beneficial in some cases for expats who would not have otherwise received the stimulus payment, just because they didn't, when they drafted the rule, they didn't really consider that for whatever reason. So just know that there is money on the table that can be claimed if you haven't claimed it yet. If you did file and didn't receive the payments, you can still, there's probably certain reasons why. One, the check never got to you. So international mail sometimes is not great for receiving money, or you moved since originally filing and they looked at your old address and sent it there. So there is a process where you can kind of recover. It's called like a refund trace, essentially. You can submit a refund trace for like ones that you should have received but didn't receive, and then essentially they'll issue it to the new address that you put on the form. So there is you could if that applies to you, you could just Google IRS refund trace, and you can usually find a process for that. There is a specific process for the stimulus payments, but I think most of the sites usually bring that up. We also do that for clients. We have a process in place where we'll submit those refund trace payments or refund trace forms to the IRS for clients. So that's something to consider if you haven't received those, and you should have in the first place. And with that, that's kind of all the topics I wanted to talk about today. I will open it up for any questions that anyone has right now. And if I don't get to your question, I think I can follow up. Nigel, I'll follow up with you on how I can individually follow up if that's the case.
Okay, well, thank you, Eric. There's a few questions here which we'll deal with now, and as you say, we can deal with any other questions after the event as necessary by email or whatever. Okay, so first question, Eric. If I've been filing returns on time every year, but didn't know that I had to report my foreign business separately, and I've been reporting it as self-employed, how should I go about correcting this?
Yeah, that's actually common, kind of just what I talked about a little bit ago, actually. So that is a very common scenario where you can utilize the streamlined filing compliance procedure. So in that scenario, you'd be filing amended returns instead of unfiled returns for the previous 3 years, including the 5471 forms for each of the years needed. And then there's going to be maybe some tax elements to it as well because of the GILTI regime if you fall under that. And then also, like if you needed to update your FBARs or you didn't file FBARs along with that, you include those too. So very common scenario where that streamlined filing compliance procedure can be used.
Okay, another question. I've been using the exclusion as I only make around £50,000. However, I do have a son I claim on the return, and just now realized I could get a refund if I use the foreign tax credit instead. Can I correct that for prior years? So you could. What you would do is you could file an amended return, and I think it would be up for at least the prior 3 years. So you can only claim a refund for the prior 3 years. So right now it'd be 2020, 2019, 2018. So you can amend all 3 of those years, switch from using exclusion to the foreign tax credit on each of those years. Essentially what you've done if you do that is you revoke the exclusion, and it stays revoked for five calendar years. So it would be revoked for 2018, 19, 20, 21, and 22. Which is fine if your situation is not going to change. But let's say if you're going to move to, I don't know, the UAE, where there isn't a tax, they don't levy taxes over there. You wouldn't be able to utilize the exclusion, so you may owe a lot of tax in that 1 year. So it depends on your situation. Yes, you can do that. Just know if you do switch to the foreign tax credit, it is going to revoke your exclusion. Okay.
For that 5 years.
Okay, thanks, Eric.
Sure.
Next one. I'm a retired US citizen living in Brighton. For years, I have only been reporting my US retirement plans on my return, as I believe the treaty excluded my UK-based plans. What do I need to do?
So in that situation, you could file an amended return. Likely it depends on the situation there too, but if, you technically could probably be required to report at least your UK, sounds like employer plan, maybe individual plan. Social Security, I don't think would be subject to tax in the US. But if you're paying tax on the UK, then you could offset it with a foreign tax credit on the US return. So you could amend to claim that, amend it essentially to get the reporting correct, but you may not actually end up owing anything once all said and done, because you get to apply the foreign tax credit to offset the tax on that amended return. So that would be the way to go about it.
Right. Okay, one final question, more fundamental in many ways. I am looking to renounce my US citizenship. What do I need to consider when it comes to taxes?
Yeah, so common question we get. So looking to renounce, for tax purposes, you have to have 5 prior years and the current year that you're filing for filed and complete. So it has to be essentially your returns for all of those years need to be filed and done correctly. And then, so one other thing you have to consider is in the year you do renounce, you have to file a final tax return with a certain form that's essentially the tax equivalent of the renounced form. And it just states that I'm giving up my citizenship and don't need to file taxes anymore. But if you have over 2 million in assets, you could be subject still to what's called an exit tax. So what that form does is essentially looks to whether you are subject to exit tax or not. So keep that in consideration when you're doing that. You'll want to you essentially need to build like a budget of what all your assets are and what you purchased them for, essentially, because that's what's going to be needed on that form when you file it. And it'll look at what the net asset value essentially is of all your assets and determine at that point in time if the exit tax applies or not. But if you don't file the form, the exit tax automatically applies. Or if you haven't filed those 5 years of returns, the exit tax automatically applies. So that's why you want to make sure that you're up to compliance and also filing that form in that final year.
Okay, well, thank you very much, Eric, for that.
Yep.
We'll call it into it there. I can't see any further questions. Just to say that we're here to help you with your plans to get the best out of your time living abroad. If you have any questions, please don't hesitate to contact us at expats@expatnetwork.com, and we'll answer, or we'll find someone who can. Obviously, if you want a referral to Eric or to anybody else in our extensive network of service providers, feel free to contact us. So thank you very much for attending, and thank you, Eric. Cheers.
Thank you, Nigel. Appreciate it.
Cheers.
Have a good rest of your evening.
Cheers.
Cheers.